Hi, friends. Well, as we discussed late in our last video, we wanted to take several minutes, 12 minutes plus or minus, to talk about the next 12 months. And a lot has happened in the last 12 months, and certainly we have expectations in this midterm election year about some things that will take place. And so we want to spend plus or minus those 12 minutes kind of laying out for you what our thesis is and what we're expecting on how we can navigate the next 12 months together. So before we look forward, let's look back for a second, because it's hard to talk about what's next without realizing what we just did. So
Sure.
Last year, for some investors, was different than they might be used to. Why don't you talk a little bit about last year, where we were expecting coming into the year, where we finished, just unpack kind of the market and the returns for just a minute.
Yeah, if you think about all that was going on as we headed into 2021, we had really the first contested presidential election in certainly our adult life as investors. We had a new president, a new administration, and we were still battling COVID. But yet we were optimistic about earnings. And our discipline is to protect and grow. That was really our theme for 2021.
Yep.
And you would think we would have had more market volatility than we did in 2021. With all of those things going on in the markets, with all that was going on in our country, we didn't have a lot of entry points for cash or new money like we've had in the previous years.
Well, and really, I remember we even had those conversations back in December, January, where we were as convinced as we could be with everything that was changing societally, politically. We were going to have multiple entry points for opportunity, and it just never happened.
It didn't. You did not see the volatility. We did not have double-digit volatility last year. But when you look at the amount of risk we took, the returns we received for 21 were in line with the amount of risk we were taking.
That's a good way to say it. And we looking back, held higher cash than we would have wanted to if we would have known we weren't going to have hardly any volatility.
And we were really expecting more volatility. And we did get it, but very late in the year.
That's right.
And we saw that in September a little, but in December, we had a lot of selling going on. You had huge transitions going on from tech and growth to value, as well as people anticipating the tax law changes that might or might not come this year.
Yeah, and it really, I think one of the things we've discussed is last year felt like the plane was being built as it was being flown. Because if you go back and look at some of the heavy-handed rhetoric and language, I talked with an attorney last year who said, sort of, and I quote, "This is the heaviest-handed tax legislative language we've ever heard from a president." You fast forward, there was a big fat nothing burger that came from. So the markets sort of were, projecting out what didn't happen, and we were left to navigate. So anyway, and I like the way you said it succinctly, which is we got the returns for the risk that we took.
Yeah, and a couple other big things that were going on behind the scenes is one of our top 4 sectors, which is the biopharma and biotech sector. Its index from roughly February of 21 to today is down about 70%. Not 17, 70%. And a lot of that you can get into COVID and the lack of a FDA chairman and people that typically would be going in for certain treatment that cannot, and also pharmaceutical drug reps that would be out promoting some of these new methodologies have not been able to go into doctors' offices. So we saw a really strange shift there. And then I touched on the end of the year volatility that we really stayed away from, because we don't, and now starting to shift maybe a little bit into going forward.
That's right.
We don't see this move to value stocks as the right shift right now.
Yeah.
And we did not bite into that in late December. But what we did do was some of that cash is we started buying the investments we like for the next 12 to 18 months, but that won't show up in last year's numbers. We'll see it going forward.
Yeah, so let's talk about specifically a couple of things you just said. So you saw the video we just did, and we firmly believe we are headed to Dow 40,000, right? And that's a roughly 9 to 11% move up. And so one of the things you harped on last time was what we're calling the new performance matrix, or the new return matrix. We've had in the last 10 years, 2, 3, 4 years of 20+% returns. That is not the case anymore. And so while historically speaking, high single digits, low double digits are considered excellent returns, we need to rewire what we're expecting moving forward.
Yeah, and if you think about where growth is coming from, we see all the stimulus, we see inflation as a headwind, the Fed starting to talk about raising rates and stamping out inflation. But when you look at earnings, we still see earnings growing.
Yes.
It's the cost of those earnings, and it's the cost of doing business, employment costs, and other things going up. And so back to biotech and biopharma, our job is to find areas of the market where the value for what we're buying for something has not been realized yet. We could go out and just buy the market, buy tech, and buy the things that are popular, but the market's already realized those values. Our job is to go find investments that are undervalued and to move out of things that are at value or overvalued. So in the short term, it can feel a little wonky.
Yeah.
That's a technical term, by the way, wonky. But it can feel dislocated, frustrating. But remember, we're moving investments in for what we see the next 12 to 18 months. And eventually, we expect the biotech, biopharma world. In 2016, one of our favorite funds was down 16%. 2017, 18, 19, and 20, unbelievable type of returns. Now, history doesn't guarantee the future, but it is indicative of when something goes down and the fundamentals are still in place, that's an opportunity to buy.
Yeah, and really what you're saying, which I think is worth harping on, is while we're expecting real forward-looking returns based off of fundamentals and earnings, we disagree with this faux shift from growth to value. We think value has a place in the portfolio, and you're starting to see us nibble there, but there's still plenty to like in the growth space. And so the other thing you're saying is the markets are not a reflection of underlying value. They're simply a reflection of the price that somebody will pay you for that today.
The lowest price.
Right? So imagine if we had to go home every day and see a sign in the yard about the lowest price somebody pays for our home. Who cares? We're not moving. And so when we look at some of the sectors like biotech, and we're going to talk about some of the other ones we like, we're saying the markets might not realize the value yet.
Like financials. Think about financials. 5 years ago, 3 years ago, financials were so undervalued and so just being taken out back and beaten up. And we were starting to nibble and buy and own. Because listen, if we get the highest high or the lowest low, that's luck.
Yeah.
But to have the cycle down, and one of our disciplines is risk is not measured by what you own.
Mm-hmm.
It's measured by where you own it in the cycle. And so we were buying into financials when they weren't popular like they are today. And even inside the financial sector, there's still value. And we're looking for things that we think will do well over the next 12, 18, and 36 months. So it is a time of shifting, a time of opportunity. The volatility is hidden in the market, but there is some volatility showing up, and we've been nibbling into that.
And so I want to go, because we've talked about biotech, I want to go into some of the other sectors we like, but I want to preface it with this, which is something we talk about regularly. If you were to take the S&P 500 and sort of pop open the hood, you see 12 separate sectors. You've got real estate, energy, healthcare, right? So 12 separate sectors. Theoretically speaking, that means if the S&P 500 is 0% return, half of them could be positive 20 and half could be negative 20. And when you weight them together, you get 0% return. So as investors, which sectors you're allocated to has a huge impact on your return. And the reason I want to point that out is some of the sectors we like, we might be a little early to the party. Some were right on time and others were fashionably late. But the point is we like them as we look out to value and earnings. And so some of the other sectors I know that we like right now are financials. And you talked about sort of banking, but mergers and acquisitions.
Yes. You have all this money, all this liquidity, and it's trying to find earnings and profits. And so in the public markets, we got to remember there's only so many public companies.
That's right.
And so they're buying providers, they're buying suppliers, they're buying clients, and you're going to see this. And so in companies like Blackstone, Apollo, Carlyle, and other companies that are in that, we believe mergers and acquisitions could see record numbers in the year ahead.
That's right.
Banking is changing dramatically. So you don't tend to see us in the traditional bank stocks. You see us more in the big financial service firms that do mergers, acquisitions, and banking.
Yeah. And I had a conversation with one of our business owner clients just yesterday, as a matter of fact. And the difference between what CNN, Fox News, or whatever says...
Cartoon Network.
Yeah. Yes. The trio says business and economics look like is far different than the actual bank accounts of the business owners we've been talking about. Profits are real. Companies are growing, and people are flush with cash looking to buy income-producing companies, whether it be suppliers, distributors. So we are a firm believer that we are still well below where the end of the business cycle is, especially in something like mergers and acquisitions.
We do, and I see that 12 months in 12 minutes is already crossed the 12-minute threshold. And so as we wrap up and think about this year, we believe midterms and the midterm elections are going to dominate the news cycle. So the liberal media won't want to be negative because they'll want their people reelected. The Republicans and the conservatives will be hard charging. And so we think that the sectors that have been punished because of COVID and maybe the liberal legislature could dramatically change in the second half of this year. And so the opportunity is there. We're going to keep our ears open. We're going to watch this midterm election and act appropriately. But it looks like right now we'll see major changes in Washington. So those themes will be driving us throughout the year.
Yeah, that's good. So we like technology. We like biopharmaceuticals. We like mergers and acquisition and finances. We are looking for opportunities with the cash that we have. We do expect volatility this year, but volatility in a sense that gives us opportunity.
Yes.
And I want to make one quick plug is we want to spend more time on unpacking the midterm elections and what our forward-looking thinking is and what happens if. That's going to be in our February client gathering that we'll live stream for our clients who don't live locally. You don't want to miss it. More news to come. But for the next 12 months, we are optimistic, we are ready, and we feel very confident about the sectors we own and will continue to own.
That's right. And even with the sell-off in technology, we still believe innovation, robotics, and all that is coming with the metaverse, and maybe that's a fun thing. And also send in your questions, because it's nice to hear from you guys as what you might want us talking about in the videos going forward.
Good. Thanks for watching. I'll see you next time.